Quilter's Markets Uncut podcast, your weekly insight into the topics and issues that we have been discussing here at Quilter. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you are listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm Andrew Cartwright, investment manager based out of our Birmingham office, and this week I'm joined by regular commentator and head of fixed interest, Richard Carter, and fund research analyst, Matt Ennion. Welcome, Richard and Matt. So in terms of economic data and news from last week, the main headlines came from the European Central Bank, who left interest rates on hold for the fourth month in a row at a record high of 4%. And a consensus view from the ECB committee was that it was still too early to even discuss rate cuts, as pricing pressures have yet to be fully extinguished and many wage negotiations are still ongoing. In the UK, consumer confidence rose for the third consecutive month to a new two-year high, albeit it is still slightly in negative territory. The recent reductions in national insurance, falling mortgage costs, and real rising wages were all cited by commentators as likely explanations. It was also announced that the US economy grew at an annualized rate of 3.3% during the last quarter of 2023 and 3.1% for the year as a whole, making it the world's fastest growing advanced economy. So, Richard, last week was fairly quiet, certainly in terms of the volume of news flow, but nevertheless, there were some important announcements from the ECB and those US GDP figures. But this week is likely to be far more interesting, with both the US Federal Reserve and the Bank of England meeting to discuss interest rates. Firstly, was there anything that you thought was particularly noteworthy from last week? And secondly, and perhaps more importantly, with financial markets still very much being driven by the likely timing and speed of interest rate cuts in the US, what are your thoughts and expectations of those forthcoming central bank meetings? And how have markets been reacting recently in the run-up to those decisions?
Yeah, good question, Andrew. I mean, I think sort of like you say, last week's announcements, nothing massively shocking. I think still very much in the soft landing kind of narrative, in a sense of growth is holding up. You know, it's talk and worry about recession. It just never seems to come to anything, does it? Really, just growth continues to hold up in particularly in the US pretty well. Even here as well a little bit, and inflation pressures seem to be easing as well. You know, absent kind of a major shock coming out of what's happening in the Middle East. So it's all kind of good for markets, but it's not really pointing to any need for central banks to sort of cut rates imminently. And that's, I guess, that's kind of the slight change we've had this year. You know, earlier in the year, at the start of the year, people expecting rate cuts pretty early in 2024. That's gradually getting pushed back as the data kind of continues to kind of surprise on the upside. So you're absolutely right. Big week for central banks. Got a Fed meeting, got a Bank of England meeting. And I think it will be, they might move a little bit more in a dovish direction. They might sound a little bit more open to rate cuts at some point later this year. But like I've just been saying, the data doesn't point to any great urgency to do it now. And I think they'll say, particularly Bank of England, that the job's not quite done on inflation. And it needs a little bit more time, with rates at pretty high levels before they're comfortable to cut interest rates. And I think kind of markets, are kind of fine with that. They kind of understand that the central banks aren't going to rush into this, but they're still hoping that as the year goes on, we will see easier monetary policy. So I have to wait and see. I think Bank of England, potentially quite interesting on the split in the vote. So last month we had 6 people voting for no change and 3 people on the MPC voting for rate hikes still. Maybe we'll start to see that move a little bit in a different direction, of less people voting for rate hikes, and perhaps even people starting to think that rate cuts, are on the agenda for some of them, but overall the majority of the committee, I think, still very much holding rates high for the time being.
Now, we've heard Richard regularly discussed bond markets and inflation and the direct impact that interest rates have had, given the inverse relationship between bond yields and prices. And up until 2 years ago, UK interest rates have been less than 1% for well over a decade, and bond yields have reflected that. And during that time, infrastructure and commercial property provided a very useful alternative source of income, albeit with a different risk-return profile to bonds, with yields typically in the region of 5 to 6%. But of course, interest rates have since spiraled to 5.25%, and it's not been surprising that 2022 and 2023 were such difficult years for bonds in terms of prices, and in particular, long-dated bonds, which are much more sensitive to interest rate changes. But last year was also very challenging for infrastructure investments, and it has become very clear that interest rates have not just affected bond markets, but also infrastructure, commercial property, and some other alternative assets. So I'm delighted to be joined by Matt Ennion, a fund research analyst specializing in alternative investments and infrastructure, to find out a bit more. So Matt, you spoke with Edward Lloyd on the podcast back in July, and it would be very interesting to find out what has been going on since then. But perhaps you could start off with a quick overview on the various types of infrastructure that we invest in, their key characteristics and drivers. And perhaps you could help us understand the relationship with interest rates, which has become more apparent in the current macroeconomic environment and certainly I had expected.
Yeah, morning everyone. Yeah, thanks Andrew. No problem at all. So infrastructure can sort of very simply be split into sort of three sectors. Effectively, you've got sort of core infrastructure, core plus infrastructure, and then renewable infrastructure as well. And as I'm sure you'll understand, there's various nuances between each one, and even within sectors, there's various nuances between all the various trusts that we can invest in. Each portfolio is very different. They all have unique assets. So bearing that in mind, but just from a high level, the core infrastructure trusts are simply sort of investments that are in assets that provide essential services. So things like hospitals, schools, where you get very predictable revenues. These are assets that are very much based on availability. So they're usually long-term contracted revenues over sort of 20 or 30 years, and as long as those assets are available for use, then the owner of the asset gets paid a revenue. So quite low risk, as long as the assets are available, and certainty of cash flow. So good yielding, low risk assets there. If you move on to core plus type of assets, and these are a little bit higher risk, I suppose. You're really rather than investing directly in the asset, you're investing more typically in a corporate entity, so a company where they've got management teams, and they're really looking to grow revenues, and investors typically will look to exit the investment over sort of more like a 5-year period to make a return. Examples of assets, these companies invest in assets, and the examples of those would be sort of things like tower companies, data centers, logistics businesses. So these are still infrastructure assets, but very much sort of more development type of assets. So higher risk. Having said that, there's still contracted revenues in them, so you're still getting some good long-term cash flows within them, and these assets similarly yield quite well. And then finally, the final type of infrastructure asset really is renewables, and that really means, so I'm sure you're aware, investing in renewable assets that generate electricity, and they get paid for supplying electricity to the grid. So things like wind and solar, hydro, and battery storage, they're the typical types of technologies that you get. Again, revenues on these types of assets are dependent on sort of the long-term nature of the contract. So many of them will have subsidies over 10, 15 or so years. That makes them less risky. Some of them will have what they call power purchasing agreements, where there's an agreement to sell energy over a period of time at a certain price. Again, if you have a good power purchase agreement, then clearly that reduces the risk of these types of assets. So again, you can get some good long-term cash flows and good yielding assets. So that's the sort of summary of the types of assets that we can invest in. In terms of the impacts on these types of investments, you've got sort of we talked about interest rates earlier on with Richard, and these have had a big impact on the sector as a whole. I suppose there's sort of three sort of mechanisms that interest rates impact on the sector. I suppose firstly, when you look at bond yields have gone up. These types of assets, given that they've got long-term cash flows, are seen as bond proxies in very simple terms. So at a high level, there's now a substitute. Interest rates have gone up. They're more attractive, which means that there's a substitute for these types of infrastructure assets. And so people have switched from infrastructure into bonds. So, where bonds have perceived as less risky, so it sort of makes sense to do that, and that's had an impact on the returns of infrastructure trusts. The second one is second impact is a little bit more technical around discount rates. So infrastructure projects are valued using a discounted cash flow model. So the long-term cash flow streams are discounted at a discount rate. So you discount the cash flows back to the present value, and that gives you the current NAV. So as interest rates go up, discount rates similarly go up. And as they have done over the last sort of 12 or 18 months, that will then reduce the overall current value of these cash flows, reducing the value of the overall assets. So that's had quite a big impact. And then finally, there is debt within the structures of investment trust. So the investment trust can gear, they have debt at the trust level. And obviously, as rates have gone up, that debt has become more costly, and that cost has sort of reduced the overall value of the asset. So they're the sort of three mechanisms, really. Just a final point on this is that there is an offsetting mechanism here as well, and that's inflation. And typically, as inflation goes up, interest rates go up. So there is an offsetting mechanism here where a lot of the contracts within these trusts are inflation linked. So as inflation has gone up and revenues have gone up, then that's offset some of the negative factors of the impact of interest rates on these trusts. So it's not all one way, but interest rates haven't been a positive over the last few months or so.
One of the key benefits of discretionary investment management is that we invest in company shares, bonds, and funds that are tradable on a daily basis. Now clearly, Matt, some of those investments that you were talking about, so the renewables and wind and solar farms and hospitals, we're not going to invest directly in those. So typically, we invest in them through collective investment funds that are either tradable on a stock exchange or directly with a fund manager. And in the case of infrastructure, this typically tends to be the investment trust structure. So, Matt, could you tell us why the investment trust structure is so commonly used for infrastructure, and also the likes of commercial property than say, an open-ended investment company? And what are the pros and cons of that structure?
Yeah, sure. Yeah, no problem. I think the key factor here is just the permanent capital of an investment trust. So once an investment trust is launched and people are invested within it, then that capital is permanent. When you have an open-ended fund, the capital comes in, and as people sell units, then that capital can go out again. And the key factor here is the fact that infrastructure is obviously a very large and a liquid asset class. You're buying big, lumpy assets. They're not easy to sell. And so the permanent capital is very important here, where we've seen in the property space with open-ended funds, when there's mass redemptions, you need to sell assets. These open-ended funds have to close because property takes 6 or 12 months to sell down, and you can't meet the redemption repayment. So it's a similar story in infrastructure. As I say, big assets, private assets, illiquid. There's no immediate secondary market. You have to find a buyer. So the permanent capital is really important. So that's the key reason why infrastructure and private assets more generally are generally held in a close-ended investment trust as opposed to an open-ended fund. I think just moving on to the positives and negatives, clearly most of these big assets, infrastructure assets, have historically been held in private hands or in pension funds. So it's very difficult for private investors to get access to exposure to these types of assets and sectors. So I think an investment trust is really important, and it's sort of cloned as democratization of private assets, and it's made it much more liquid and accessible to private investors to get access to this space. I think also just we're obviously all aware of the amount of investment that's needed in infrastructure and renewables across not just the UK but across the globe, and I think having a trust like this, it just enables another way of enabling the UK to build these assets, and renewables in particular, to help the UK meet net zero requirements. So it's another method of that, and so investment trusts are a very important part of meeting our net zero requirements. And I think finally, on the positive side, you've got some good boards. Each investment company has a board of sort of 5 or so people, and we've engaged a lot with these boards. They, oversee the trust, and there's some really high quality people who've been in the sector for a while, and they help oversee the investments, the managers, and the capital allocation within these trusts. And that's a really important factor with the quality of a trust. I think on the negative side, we've sort of alluded to it, that you can get discounts where the share price and the NAV don't meet, and you get a discount where the share price is a lot lower than the NAV is suggesting the underlying assets are valued at, and that's a negative. And as I say, the boards are important here to try and manage that by using various factors, things like buybacks and what have you, to try and reduce that. But that can be a negative, clearly, particularly if it persists, and when you're not, the share price is not pricing in the true value of the shares. And clearly, the other factor is potential illiquidity. Although there's a secondary market for the shares of an investment trust, sometimes not as liquid as you might want, particularly if you're dealing in quite a big size, and so that can be a hindrance as well for these vehicles.
So from an investment manager's perspective, infrastructure has a very useful role to play in portfolios, and especially from an income perspective. And thanks, Matt, for providing an overview of the influence of macroeconomic factors. We've also identified that in order to have that daily liquidity in what essentially are illiquid assets, we have to accept that the investment trust structure does come with an element of equity risk in terms of that premium discount mechanism, and that can have an adverse effect during periods of stress, which we've been experiencing recently. So finally, Matt, in terms of an update since you spoke with Edward last summer, and that has been a very volatile period for financial markets, what has been happening with infrastructure, and what are your thoughts for the coming year? Are we simply waiting for interest rates to be cut, or for market sentiment to improve to narrow those discounts, or will there be other factors to watch out for? We, of course, do potentially have a UK election coming up. And could the prospect of a Labour government have an impact, and perhaps notably on private financial initiatives?
Yeah, I think broadly the outlook is pretty positive, to be honest. I don't think you can get away from the fact, as you've suggested, that interest rates are going to have a big impact on the progress of these sectors going forward this year and beyond. I think we are, well, hopefully close to peak rates, and once we do get some more clarity on that and more visibility on the path of rates, then I think the sector should start to perform much better, particularly if we start to see interest rate cuts later in the year. So I think there's no doubting that that's pretty important for this space this year. In terms of politics, I think you'll remember back in the previous election when Jeremy Corbyn suggested he was going to rip up all the private-public partnership contracts, and that would have had a huge impact on some of the core infrastructure space. Clearly, that hasn't happened, and I think things have moved on from there. So we see the Conservative and Labour Party are very constructive on sort of the net zero policies and infrastructure spend more generally. So I don't see any immediate sort of impact in terms of policy. I think maybe if you get some policies that could potentially put pressure on government spending or the deficit, which again will impact interest rates, then that could have an impact on the sector. But I don't think it doesn't, at the moment at least, seem that we'll see anything from a policy perspective that could, around infrastructure that should derail the investment case. I don't think. I think there's a lot of, as I've sort of suggested previously, I think as interest rates, we do get more clarity on interest rates, then I think the sector as a whole should rally. But I think as we move forward, there'll be quite a stock selection will be quite important. I think trusts that have done a lot of work on managing their debt levels, carrying out buybacks, making good capital allocation decisions, making sure they've got strong pipelines of future investments going forward, and really sort of demonstrating that they've got a long-term growth path from here will do very well. And I think potentially some of the bigger, more liquid trusts as well. But I think there will be some trusts that perhaps go by the wayside, smaller trusts, ones that haven't been managed particularly well, or the boards haven't been particularly proactive, and they may get left behind eventually, I think. And we have seen some merger and acquisition activity across, the infrastructure space, as well as, the broader investment trust sectors. And I wouldn't be surprised if we see more of that as boards really want to maneuver themselves into a position where they've got a long-term future. But I think as a whole, things look reasonably positive if we get some clarity on rates. And with the way the discounts are today, they're pricing in a lot of bad news still, even though we've seen, a bit of a reduction in the discount. So I think there's some potentially positive returns to come from the trusts in the coming months and years.
Well, thank you very much, Matt, and to Richard for those great insights today, and to you all for listening. Did you enjoy our discussions on the podcast today? We love to hear from our listeners, so please review the show now wherever you're listening and share it on your socials and tag us at Quotachievate. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week, and in the meantime, head over to our website, www.quotachievate.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. Finally, if you have any questions you'd like to ask one of our experts for our next podcast, then simply ask them via the weekly comments page on our website. We love to hear your questions. And that's it for today. So thank you again to Richard and Matt, and to you all for listening. See you next time.